The war in Ukraine is a substantial upside risk, especially to energy prices.
We should make all-out efforts to support Russia and Ukraine in reaching a ceasefire.
We're constantly engaged in a discussion with President Putin. The conditions he put on the table are not acceptable by anybody.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. EU leaders meet in Versailles to discuss energy and defense. In the U.S., President Biden will demand the end of Russia's preferred trade status. The ECB accelerates plans to wind down stimulus. Christine Lagarde says the war in Ukraine is a substantial upside risk. And red-hot inflation, U.S. CPI hits a 40-year high. Petrol, food, and rent drive prices increases in February. The figure is likely to be even higher following Russia's invasion of Ukraine. Now, first thing is first, let's check on the markets because we have a lot of news to get to. Of course, we're following the proceedings in Versailles. Moments ago, we had the Prime Minister of Spain. Before that, it was Luxembourg. And we also saw Sweden. Now, European stocks gaining 0.3%. A bit of fluctuation in the last 20 to 30 minutes or so. But for the moment, they're holding on to gains. Now, this is despite a lot of questions about monetary policy divergence around the world. And this is despite, of course, that inflationary pressure really coming at the forefront with the U.S. CPI imprint. Also, when the ECB was talking about the need to not only stay the course, but maybe readjust to bring forward some of the monetary policy change and readjustment and tightening, it really widened the spread between, for example, BTPs and bunds. Okay, travel and leisure, the biggest gain in today's trading session. The U.S. 10-year yield briefly actually touching 2% about 3-4 hours ago, now at 198.47. And then crude oil, the biggest story in the last couple of weeks, gaining some 0.2%. Now, that's giving a bit of a boost, I guess, of stability when it comes to energy prices to the FTSE, the CAC and the FTSE MIB, and then we look at the DAX gaining some 0.7%. Now, two cities in western Ukraine have been so far far away from the fighting until last night when they were hit by airstrikes. Joe Biden is set to call for an end to normal trade relations with Russia, while the Senate approved a $1.5 trillion federal funding bill to aid Ukraine. Now, Vladimir Putin has proposed a ceasefire. However, his demands won't be met by EU leaders.
I have to confess that today, the conditions he put on the table are not acceptable by anybody.
Well, joining us now to spell out the situation on the ground is our Europe correspondent, Maria Tadeo. Maria, what are we expecting from Versailles in that summit?
Well, Francine, as day two, of course, we know that yesterday was a long debate, lasted for 5 hours, went on until 2:30 in the morning, and it produced a statement on Ukraine, which does not make an explicit reference to fast-track membership. Remember, that is what President Zelensky said he wanted to see out of this summit. That is not there, but European leaders did agree that Ukraine belongs to the European family, and there is a European perspective for the country in accordance with the treaties. Having said that, there is still a big debate, and we're expecting that it will happen this morning around energy. I spoke to the Slovenian Prime Minister just a few minutes ago, and he reiterated this is a debate that is ongoing. How big do we want to go on these sanctions on Russia? He told me, I'm of the opinion that we should ban all imports right now. The same goes for the Polish Prime Minister. Having said that, we've heard from a number of countries suggesting this is simply not realistic. The impact that it would have on our economies could possibly send the European economy into a recession. And just on an everyday life basis, Francine, it would mean that some industries would find it difficult to get the power that they need. So this is an ongoing conversation. But of course, the backdrop here is of an attack that is becoming more brutal by the day. The scenes at Mariupol, Francine, have really shocked everyone here. Of course, that hospital with pregnant women that was bombed 2 days ago. Russia, by the way, denies that hospital was active, and they say that it was a base for ultra-nationalists in Ukraine. Of course, the Ukrainian government denies all of this.
Yeah, I mean, of course, Russia denies any kind of military operation. I mean, they say this is no invasion at all. We're just seeing there the Commission President, Mrs. von der Leyen, arriving also in Versailles. Maria, this goes back to the tension between EU leaders, like, you know, everyone really, all citizens of the world shocked by some of the violent pictures that are coming through, wanting to hurt the Russian economy, really trying to make sure that the sanctions also maybe reverse course when it comes to that military operation. But the pain also in which every European citizen will fall, especially households, if the price of energy goes that much higher.
Yes, Francine, and I'm often reminded when you look at the impact that sanctions are going to have in an economy like the United States, for the sanctions that we put in place, they stand to lose $1. When you look at the impact on the European Union, it's 10. So for every one they lose here, some governments would lose up to 10. So of course, the impact is much more severe here. The other thing, of course, that factors here is not just the economic fallout, but really the diplomatic way forward. And that also splits opinion between European leaders. Some who still believe there is a way to engage with Russia, to go for a ceasefire, and to really end the brutality of wars. Others, including the Estonian Prime Minister, who will tell you there is no diplomatic will on the part of Russia. There will be no diplomatic solution as long as Vladimir Putin continues to believe that Ukraine is existentially a part of Russia.
Bloomberg's Europe correspondent Maria Tadeo, thanks so much, of course, for some great work on the ground. And we see the leaders continuing coming in. I think I also heard a helicopter above Maria, so we could see someone coming in that way. Now, in response to the war, the ECB unexpectedly accelerated its wind down of stimulus. President Christine Lagarde's main concern seems to be that the conflict could propel prices even higher.
The war in Ukraine is a substantial upside risk, especially to energy prices. If price pressures feed through into higher than anticipated wage rises, or if there are adverse, persistent supply-side implications, inflation could also turn out to be higher over the medium term.
Well, joining us now is Monica Defend, head of the Amundi Institute. Monica, thank you so much, as always, for joining us. How much impact does this have on inflation, much longer term? It's going to be a shock in the short term. What happens after that?
Well, we think, we have been calling this a regime shift, meaning higher inflation, lower growth. If it's a regime shift, it means that it's going to last for longer than 1 year or 2 years. So we really, and we were a bit surprised by the expectations that the ECB delivered yesterday, because just for 2022, we are already reaching 6% forecast on the CPI. Obviously, it is rather difficult to pencil forecasts amid macro fundamentals that are going to be strictly related to the evolution of the geopolitical risk. But inflation is going to be higher for a protracted period.
Yeah, Monica, what does that mean? And I have to say, when we were looking at the press conference of Christine Lagarde, you saw that widening spread between Italian and, for example, German bonds. What would a policy mistake from the ECB today look like?
Well, the ECB has a dual mandate: inflation and the transmission of the monetary policy, policies. And this is channeled through the spread, being credit or peripherals. It is clear today that the ECB is focusing on controlling inflation, despite they have just 5.1 expectation for the year. They are not that worried on the transmission of monetary policy, just because maybe for them an alert threshold on the BTP bond might be 200, and we are not there yet. However, we do think that the EU plan might be a game changer into this situation.
Monica, what does that mean for then how nimble you have to be in your portfolio? The situation in Ukraine could escalate or it could de-escalate, so you would have to have two very different market views.
Yes, indeed. For the time being, we remain quite cautious. We've been putting in place a lot of hedges on the credit exposure, as well as the equity one. So the first objective for the time being is to manage the risk and protect the portfolio. Then, when more visibility will be on the radar, we might put in place some relative positioning in between US and equity and European equities, for example, as we do think it will be the case for Europe to pay an higher toll than the US.
Monica, what does it mean for when you look at some of the equities? And I know you're saying you're maintaining a positive outlook on some of the value stocks. When do earnings get hit by this higher inflation?
We think that it is not yet there. If you look at the difference between PPI, producer prices, and the CPI, the gap is extremely wide. It means that this higher pressure on cost has not been transmitted, passed through the final consumer, and this eventually might have an impact on squeezing the margins. So when it goes to the European earnings, we might also see the risk, a higher risk for an earnings recession. So we won't be surprised to see earnings in the euro area between -5% and +5% growth.
Okay, Monica, thanks so much. Monica Defender, head of the Amundi Institute, stays with us. We're also looking at Didi slumping 20% in pre-market in the U.S. right now. It's set to halt the Hong Kong listing on, of course, this data probe. We've been following the Didi story right from the very beginning. This has not been confirmed yet, but it was the biggest story overnight, away from what's happening in Ukraine. Now, we understand that it failed to appease the Chinese regulators' demand that it overhauls its system for handling sensitive user data. This is according to Bloomberg sources, and therefore it has suspended preparations for its planned Hong Kong listing. Coming up, U.S. CPI hits a 4-decade high for February. We explore the latest data from the Fed and its impact with Monica Defend. This is Bloomberg.
The numbers were in line with expectations.
Inflation's not likely to roll over.
Not only is it not slowing, it actually continues to accelerate.
Higher commodity prices, higher food prices, higher input costs. That's difficult for central banks and for equity markets.
We kind of have to see what the fallout is from the invasion of Ukraine.
How long this conflict plays out and how disruptive the sanctions regime actually is.
This is really just something that makes a very difficult situation worse.
We're going to hear a normalizing, not tightening message from the Fed.
Sitting on the sideline isn't an option. I think they have to move.
I think the Fed has no choice but to sort of lean toward the more hawkish rhetoric.
We can expect probably fewer interest rate hikes than people were projecting, just 3 or 4 weeks ago.
You have to go cautiously.
This is obviously a tricky time for the Fed.
Well, that was Bloomberg TV guests weighing in on the latest data out of the U.S., where inflation hit a new 40-year high. Now, most of the impact from the oil surge hasn't been felt yet, according to economists, but traders are weighing the implications for Fed policy. Well, still with us to discuss U.S. CPI data and the wider markets is Monica Defend in Milan, head of the Amundi Institute. Monica, I want to talk about U.S. CPI and, of course, the Fed, but I also want to go back to see what the German bonds have been doing over the last, I think, 2 or 3 days, and the fact that they were really whipsawed yesterday. The ECB taking most by surprise. ECB saying they're staying the course on inflation, but really it does seem that the hawks are in charge. What's going on?
Well, we were quite surprised about the disconnection between the initial statement, where Christine Lagarde was emphasizing the risk to the downside on growth and on upside and inflation, the forward guidance, namely the acceleration on the APP, and then the projection. So it looks to me there is a kind of disconnection, and eventually the risk might be the one of the anchoring inflation expectation, and this might have a brutal effect on the markets. While obviously it's a kind of having an impact on the transmission of monetary policy, as you have been seeing the spreads movement. I think that eventually what she wanted to do was to leave in the hands of the EU to deliver a plan, which is I think it makes sense, because it cannot be the central bank, it cannot be on the monetary policy, it has to be on the fiscal policy. This crisis is going to exacerbate an already uneven outlook across countries and across people. Inequalities are on the rise, and this is something we need to pay attention.
Yeah, and Monica, I guess, the question is, the fear of another recession is never far away in the euro area. Talk to me a little bit about how you play the differentials between what we're seeing, for example, in Europe and the US with what the Fed is programmed to do.
We think that the monetary policy course is really different in between the Eurozone and the United States. When it goes to the United States, we were already judging that the market overreacted in terms of expectation of on rate hikes, for example. So we stay with the idea that they will deliver 4 hikes this year, and still on the quantitative tightening, they need to be smooth. But they are really on a different point of the cycle because of the energy dependence, because of the geographical proximity of the Eurozone when compared to the United States.
Monica, thank you so much. Monica Defender, head of the Amundi Institute, joining us this morning. Now, coming up, Premier League football club Chelsea's sponsorships are beginning to unravel as sanctions against Russian owner Roman Abramovich bite. We're live from Stamford Bridge next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, prominent football club Chelsea's sponsorships are beginning to unravel as sanctions against Russian owner Roman Abramovich kick in. Mobile phone company 3 has become the highest profile sponsor to cut ties so far. Now, for more, Bloomberg's Leanne Gerrans joins us outside from Stamford Bridge. Leanne, 3 is not the only sponsor of Chelsea. Could we see more ties being cut?
Francine, good morning to you. And as you said, yes, I am outside Stamford Bridge, which is one of the most iconic football stadiums here in London. And it really appears to be business as usual. As we've been standing here, we've seen people who work for the football club going in and out of Stamford Bridge. However, as we know, things are not as they seem, because yesterday the UK did sanction the owner of Chelsea, Roman Abramovich, because of his links to Vladimir Putin. But as you did mention there, 3, they are one of the big sponsors of Chelsea. They sponsor the T-shirts that the Chelsea players wear and the fans. You always see them when they're running on the pitch, a big 3 on the front of the T-shirt. Now, that sponsorship deal was worth £40 million. We also understand that Hyundai, the South Korean car manufacturer, is now also thinking of severing ties with Chelsea. Another thing we also have to put into context is some newspapers and some analysts are also predicting that other sponsors could now rethink their links to Chelsea Football Club. This could be Nike, who have a massive $900 million sponsorship deal with them to fund and make their kits. And we also know Hublot, which is the famous Swiss watchmaker. But they could decide to do this. We haven't heard anything from them as yet, Francine.
Leanne, thank you so much. Bloomberg's Leanne Gerrans there live from Stamford Bridge. Now, let's also get straight to Bloomberg senior writer Stephanie Baker, who's been writing extensively on this. Stephanie, if you look at the sanctions, what does it actually mean for Chelsea Football Club's future? Can it be sold? And how nuanced are these, laws or agreements?
Well, that's the big change here, is that it puts the potential sale of Chelsea in doubt. You now have an extraordinary situation whereby it is the UK government that would be overseeing the sale process. Already, there have been 20-odd bidders for Chelsea after Roman Abramovich put it up for sale, but he couldn't sell it fast enough. And now I think the sale is very much in doubt. How does the UK government oversee that process? Do they give a special license for that to go through? Any proceeds from that sale would not go directly to Abramovich. They would be frozen. What happens to the proceeds? All those questions remain unanswered at this point.
I mean, could we see something like nationalization, Stephanie, or would that be crazy?
Well, the proceeds would be frozen, and the proposal by Abramovich before he was sanctioned was that it would go into a foundation that he would control, but would go to benefit victims of the war in Ukraine. Now, could they create a similar type of setup that perhaps the UK government runs, takes those proceeds and provides support for refugees, fleeing the war in Ukraine? That's uncertain. This is uncharted territory. This is, an extraordinary situation where effectively the UK government is running a Premier football club. And there will be requests for further relaxation of the sanctions so that they are able to operate, sell tickets to games. At the moment, players can't be sold or bought, so they're frozen in terms of the player market as well.
Yeah, it's just an incredible story. Thank you so much for your ongoing reporting, Stephanie Baker, there, Bloomberg's senior writer. Now, we're also looking at live pictures of European leaders arriving. We have a number of heads of state that went into the meeting there in Versailles, talking about some of the things that they can or will not do to help Ukraine. We're expecting then press conferences maybe in a couple of hours after the leaders meet on the table possible sanctions, although this is not something that many are expecting. But EU leaders could focus on unity, they could focus on defense. So we'll have plenty more, of course, from Versailles. I'm Maria Tadeo there on the ground. This is Bloomberg. EU leaders meet in Versailles to discuss energy and defense. In the U.S., President Biden will demand the end of Russia's preferred trade status. The ECB accelerates plans to wind down stimulus. Christine Lagarde says the war in Ukraine is a substantial upside risk. And red-hot inflation, U.S. CPI hits a 40-year high. Petrol, food and rent drive price increases in February, while the figure is likely to be even higher following Russia's invasion of Ukraine. Welcome to Bloomberg Surveillance Early Edition, everyone. It's Friday. I'm Francine Lacqua here in London. Now, the market's trying to decide exactly what side of the coin they'll look at, whether they worry about inflation, red-hot inflation that we saw from the U.S. yesterday, or whether they focus maybe on some of the risks that's already been priced in. European stocks, in terms of travel and leisure, the biggest gainer in today's trading session. The U.S. 10-year yield did touch 2%, but now 1.9%. And then crude oil, the biggest story, of course, has played through the commodities and the energy prices because of sanctions on Russia after the invasion of Ukraine. And we're seeing a bit of stability today. I don't know how short-lived that will be, but certainly traders may enjoy a bit of quiet. Now, two cities in western Ukraine have been far away from the fighting until last night when they were hit by airstrikes. Joe Biden is set to call for an end to normal trade relations with Russia, while the Senate approved a $1.5 trillion federal funding bill to aid Ukraine. Now, Vladimir Putin has proposed a ceasefire. However, his demands won't be met by EU leaders.
I have to confess that today, the conditions he put on the table are not acceptable by anybody.
We're also looking at live pictures out of Versailles, where Maria Tadeo is on the ground. I think the leaders have now all entered the palace. Some of them were giving comments as they were coming in, and then we'll see what they decide and what they say coming out. Now, the war has driven some wild market moves. Perhaps the most notable was nickel, with trading suspended by the LME. Now, some hedge funds are also walking away. Luc Sadrian has been trading metals for 30 years, but he now says the London Metal Exchange is too risky to trade. Despite being ragingly bullish on copper, Sadrian is exiting all of his positions. Now, to talk about all of this, we're joined by Bain, Chief Commodities Economist at Capital Economics. Caroline, thank you for joining us. I mean, the fact that the LME actually canceled trades from a period really brings it back to some of the dark days that maybe we saw a couple of decades ago. What's at stake now for the LME?
It's hard to know where we can go from here. The risks to supply are really quite unprecedented. The gains in price have definitely got a speculative element, but there are fundamental reasons why prices should be moving higher. For the LME, they do have to restore confidence in their ability to be the price setter, and the sort of moves we saw this week probably undermined their credibility quite a bit.
So what does it mean, Caroline, that actually some of the price fixing could move elsewhere, or will this, panic be short-lived?
I think the gentleman you were referencing just before, it's made traders very nervous. that there can be these sort of moves in a day. So it will take time to restore confidence in the LME. The LME has already been losing some ground to Shanghai Futures Exchange, for example, but I wouldn't write off the LME just yet. I think we've had a week of extremely volatile prices, commodity prices, and they just need to batten down the hatch and show that they can manage things a bit better.
Yeah. Caroline, how much more volatility are we going to see as we figure out the second and third round effects of sanctions? Does it impact commodities that we haven't thought about yet?
Yes, I think so. I mean, there are obviously the commodities that Russia produces, and they've been the ones that we've seen the prices really go through the roof. But if as we think likely, energy prices are likely to stay high for much longer, whatever the outcome of the war, I think we're in for a period of high energy prices, and that, of course, raises the cost of production of nearly all commodities, but particularly some agriculturals and metals, of course, are very energy intensive. The production of them.
So, Caroline, when you look at, be it copper, nickel, and it's actually amazing when you see what happened with nickel, that the person that wanted a short position now wants the banks to stick with that short position. So I don't know whether you have a take on nickel, or there's some other commodities that you think are more interesting out there.
Well, what we do have are estimates of the risk premium in prices. So that's the element in the price that can't be explained by fundamentals, demand and supply. And while in most cases, the fundamental price has gone up because of higher production costs, because of supply shortages, etc. The risk premium has also gone up hugely, and we tend to sort of think of that as a proxy for speculation. So I can understand why the nickel investor would like to remain short at these sort of high prices.
Caroline, what's your take on
most prices? Yeah, sorry, I'm just going to say most of our price forecasts for the end of this year are lower than current prices.
Caroline, what's your take on copper? If you look at copper or some of the other ones, at what point, I don't know whether it's a bit like oil that, at a certain level, if it rises by this much, then you see automatic demand destruction as well.
Yep. I mean, that's another thing that we're factoring into our supply and demand at the moment, is that at these sort of prices, people are going to be very reluctant to buy, and you start to see substitution where possible, thrifting, or simply just holding off from buying until a time when you feel the price is more acceptable. The other point worth making is that the latest data out of China just this morning, bank credit was quite weak, and because of the supply side being so constrained, I feel as though the metals markets haven't factored in the ongoing slowdown in China's economy, which is a major threat to demand for metals.
Yeah, do you look at some of the, the rare earths that we should be looking at? I don't know whether titanium is also part of the story. And if the likes of Apple and other supply makers get out of Russia, does that dent demand, or is it just very minimal?
There will be a dent to demand there. I mean, the rare earth story is going back to China again, really. China's monopoly of the refining of rare earths is a vulnerability that I think that the West knows about, and we've heard about potentially opening mines in North America, etc. But that is something that could one day be a threat to the big electronics companies. But that's a China issue more than a Russia problem.
Caroline, thank you so much for joining us. Caroline Bain, their Chief Commodities Economist at Capital Economics. Now, we'll have plenty more, of course, on the commodity story. Also, in a moment, we'll analyze China's role in the Russia-Ukraine crisis. That's coming up shortly, and this is Bloomberg. Well, we'll have plenty more, of course, on the Bloomberg Business Flash, because we need to find out exactly what's been happening in Ukraine and Russia. We also have a full market checkup on the way with your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. Meta Platforms is reported to have temporarily altered its political expression policy to allow for some use of violent speech. The parent company of Facebook says it will allow for calls for violence against Russian invaders in the wake of the attack on Ukraine. Calls for violence towards Russian civilians will not be permitted. JP Morgan, the biggest bank in the U.S., along with Goldman Sachs, is pulling back from Russia in response to the country's invasion of Ukraine last month. Goldman Sachs says it plans to close its operations there. JP Morgan calls its activities in Russia limited. And singer and fashion entrepreneur Rihanna is working with advisors on an IPO that could value her Savage X Fenty lingerie company at $3 billion or more. Bloomberg has learned a listing could happen as soon as this year. Rihanna's company raised $125 million in January. And that's your Bloomberg Business Flash. Francine?
Thank you so much, Angel. Now, the Chinese Premier Li Keqiang told the National People's Congress that the Chinese government will meet this year's about 5.5% growth target, but he also said doing so will be a challenge and will require additional support measures.
Achieving a growth rate of around 5.5% is actually achieving stability at a high level, which is equivalent to progress and won't be easy. There must be support from macro policies. We will make our COVID policies more scientific, more targeted. In terms of Ukraine, China believes every country's territory should be respected. We should make all-out efforts to support Russia and Ukraine in reaching a ceasefire. If the U.S. chooses to ease its export restrictions on China, there would be an even larger trade volume.
Well, to talk about China, of course, the read across between Russia and China is Damien Sassower, Chief Emerging Market Credit Strategist at Bloomberg Intelligence. Damien, thank you so much once again for waking up early on a Friday for us. Beijing attempting to remain on the sidelines while casting, of course, shade on U.S. NATO for provoking Putin. So what is China's continuing role in the Ukrainian crisis?
Well, Francine, it's stability, clearly. And what China did over the week, I mean, in terms of widening the FX band, basically, yuan ruble was basically lagging dollar ruble for the better part of this week. It couldn't find a clearing price. But once it announced that it's widening the band from 5%, that means 5% movement on either side in yuan ruble, to 10%, that is bringing things more in line. And look, I mean, again, if China's trying to promote stability here, it's trying not to pick a side. That's going to become increasingly difficult in the future, especially if the West agrees on oil and gas, on banning oil and gas imports, Francine.
So, Damien, Li Keqiang also revealed that he won't be staying on as premier following the upcoming party reshuffle. What does that mean for his involvement right now?
Well, it definitely indicates a softer base for President Xi's third term, right? I mean, none of us can even speculate what's going on inside the NPC in terms of whether President Xi's going to be elected to a third term. I mean, you know, my base case is he absolutely will be. But just the fact that that he's not going to be running for the premiership here indicates perhaps a bit of a softer base. And, you know, you and I can only guess what that means in terms of China's approach to Ukraine. Again, the meetings that President Xi had this week with Scholz and Macron go a long way to sort of alleviating a little bit of the risk there, but there's a lot more still to be done, and China has yet to take a side, and we'll see over the coming weeks, certainly if the West starts banning oil and gas imports, if they can continue to do that.
Damien, I know large Russian corporates, I mean, I'm thinking of Gazprom and Rosneft, continue, we understand, to make payment on their outstanding U.S. dollar bonds. I know Gazprom did. Rosneft, I think we're still waiting for the money to arrive in certain accounts. But what comes next for foreign creditors?
Francine, this is the key question here. You're absolutely right. Rosneft made a $2 billion principal payment earlier, well, on Wednesday, actually, and Gazprom made a $1.3 billion payment. We fast forward to Wednesday of next week, the 16th. That's actually Fed Day, but it's also the day that China's supposed to make due on $117 million in coupon payments. Now, these bonds do not have a clause in it that allow Russia to make that payment in rubles. There's been a lot of talk that Russia's going to make these payments in rubles. So we'll see whether or not they make those dollar payments. But if you look at the price of the bonds, 24 cents on those bonds, you know, the market's not pricing in any such, you know, it basically pricing for risk of default. So, you know, my guess is that probably will happen. That'll kick off a 30-day grace period. And then, yes, I mean, if S&P, Moody's, and Fitch are right, you know, it's all but assured that China's going to slip into default here on its dollar bonds.
But Damien, if they pay back in rubles, and actually as a foreign entity, you don't really have access to rubles, it's basically a default, right?
The West doesn't want Russia's money, and Russia doesn't want to pay it, Francine. I mean, so, you're absolutely right. But look, I mean, in terms of these specific bonds, it's going to be a matter of, look, if you look back in 1998, yes, Russia defaulted. It defaulted on its local currency bonds, its overseas. It did not default on its external obligations. They were able to restructure that. This time around, all bets are off. And if you listen to someone like Jay Newman from Elliott, former, the guy who ran Paul Singer's, Argentina crusade going back, he believes the bonds are effectively worthless. And he also called into question the fact that these bonds adhere to UK common law. If that's contested, if indeed Russia believes that it's the Russian court system that has jurisdiction here, I mean, this could get very messy.
Yeah, it certainly could. We'll have plenty more, of course, on that. Damien, thank you. Damien Sassower, Chief EM Credit Strategist at Bloomberg Intelligence, stays with us because I also have more specific questions on some of the other emerging markets. Now, coming up, JP Morgan joins Goldman Sachs in pulling back from Russia in response to the Ukraine invasion. As Wall Street corporate exodus continues, we have more on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, still with us, Damien Sassower, Chief EM Credit Strategist at Bloomberg Intelligence. Damien, I have a million questions about emerging markets in general. First of all, where are emerging market investors? I don't know if they've had time to get out of Russia, actually, but, if they leave that part of the world, where do they go to?
Well, I've had some very interesting conversations with fund managers over the better part of the last few weeks, Francine, and heading up into March 1st, really call it February 28th, investors were able to move, local currency, emerging market debt pretty easily in size. But, after March 1st, all bets are off, and really the market has ground to a bit of a standstill. EM local debt is off something on the order of 7.5% year to date. EM dollar debt is off even more, 11% year to date. That's the worst start on record. But where are investors hiding, Francine? They're hiding in those countries that are high carry, resource rich and most geographically distant from the crisis in Ukraine, right? So that would be Latin America, Brazil, Chile, Colombia. It would be South Africa. It would be Peru. Those are the currencies that are probably up the most year to date. And then which ones have gotten punished most severely? It's been obviously Eastern Europe, Poland, Hungary, the Czech Republic. I mean, we know about Viktor Orban's comments here today. The Hungarian forint has gotten absolutely hammered off the back of this. So, those are places you probably want to avoid. And look, I mean, if things continue to escalate, it's just going to be that bid for king dollar all over again, and that bodes ill for all emerging market currencies writ large.
Yeah, and Damien, actually, we have a great chart looking at Latin America and how it's outperformed emerging markets and developed markets since the beginning of the year. Let's bring the chart up, and it really puts beautifully into a graphic what you were just saying, 13.7% year to date. Wow. But then Latin America also has issues of its own in terms of structural and things like that. So where do you want to be invested in Latin America?
Well, I mean, it's not only structural, it's political, right? I mean, we've got a big election coming up at the end of this year in Brazil. I mean, we have basically Jair Bolsonaro, all but, the polls are basically assuming that Ignacio Lula da Silva is going to win the election. I mean, the return of Lula, and this time around, look, the markets are sort of warming up to him the way they did when he initially took the leadership in Brazil going back to the early 2000s. So, I mean, it might actually be a good thing. It might even be perceived as business friendly. What's most interesting here, and I have to just pivot on you, Francine, amidst everything that's going on in the world, no one is talking about the election in South Korea, right? We had a change at the top in South Korea, and one which is actually more of a conservative shift, one that's pivoting South Korea more toward the U.S., more toward Japan. And certainly, in our opinion, we believe that opens up, I mean, look, the Democratic Party in South Korea has a supermajority there, so it's going to be very difficult for Yoon to get things done. That's probably good for local bonds and might mean less fiscal spending in the near term, et cetera. So we're looking for opportunities like that, opportunities in Asia, opportunities in Latin America.
David, I mean, something that we, again, talk about but actually haven't spent a lot of time on is Ukraine really keeping up with its foreign debt obligations, which a lot of people would have thought almost impossible. It's had to resort to non-traditional methods, for example, some of the war bonds, also involving crypto on the sidelines in order to raise funds to fight Russia. Can you touch on some of the actions taken to date and what more they can do?
Unbelievable, Francine. They actually made payment of $300 million back on the 1st of March on a foreign obligation. But since then, they've raised, I guess, nearly $550 million issuing war bonds. Now, if you're an investor looking at war bonds, good luck modeling it out. I mean, ultra short term, it's really just aid. You're providing assistance. There's no guarantee that you're going to ever get paid back on these bonds, at least in the near term. But nevertheless, the demand for these war bonds out of Ukraine are huge. And right now, bank dealer desks are basically taking them off, repackaging them, and selling them on to the end investor. So, we expect that to continue. But on the crypto side, amazingly, $50 million in crypto donations to Ukraine that have already arrived, and more to follow. So, Ukraine is pulling out all the stops, trying to raise dollars any which way it can to pay for arms, medical care, and secure communications.
Yeah, and then we have that support from the IMF and also from the World Bank. So, is Ukraine going to be okay in terms of finances?
Well, the interesting thing about it is, forget the finances, Francine. Now with the military moves that Russia's making in terms of blocking off access to the West, the money is of lesser importance, right? How do you get these supplies? How do you get these ammunitions? How do you get things to those that need it most on the ground in Ukraine? I mean, this is the beginning of that part of the fighting, and it's very, very frightening, obviously, and it's something that obviously has our focus far more than Ukraine's ability to pay for the war. It's going to be, how do you get those things that Ukraine needs it most, to the people that need it most.
Damien, if Russia defaults, if corporate bond defaults, or if something else happens, are we sure that it's actually locked in, that it doesn't have an impact on a hedge fund in Asia that then has repercussions for, Europe?
The verdict is out. I mean, there's $41 billion of credit default swaps on the Russian sovereign outstanding versus only $30 billion of bonds, right? So there's clearly a lot of exposure there. Now, a lot of that nets out, and probably by the time this is all said and done, it's not going to be nearly as much. But yes, there are certainly people that are exposed. You saw the story on PIMCO yesterday. Again, it's very difficult to understand exactly who's exposed here, but the writing's on the wall. There's going to be some pretty big exposure, and we expect further announcements similar to what we saw yesterday over the coming weeks.
Damien, thanks so much. Damien Sassower, their chief EM credit strategist at Bloomberg Intelligence. Now let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. Bloomberg has learned that President Biden is to call for an end of normal trade relations with Russia. His announcement to revoke trade privileges later today will likely come alongside G7 nations and European Union leaders. If approved by the Congress, the move would allow significantly higher tariffs against Russia than the U.S. applies to other WTO members. European Commission President Ursula von der Leyen is seeking to phase out the EU's dependence on Russian fossil fuels by 2027. Von der Leyen outlined her plan to heads of EU member governments at their informal summit in Versailles. Russia is the EU's biggest supplier of natural gas, oil, and coal.
We will rethink energy. We have to get rid of the dependency of Russian fossil fuels. And for that, we need massive investment in renewables. This is also a strategic investment in our security and our independence. It creates jobs at home, and it is homegrown. We're independent.
Russia has announced an export ban for more than 200 products after being hit by sanctions over the invasion of Ukraine. The restrictions cover items previously imported, including medical equipment, agricultural machinery, railway cars, turbines, and other products. Moscow stopped short of curbing sales of energy and raw materials, the country's most important exports. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Angel Feliciano there. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, Anna Edwards here in London. Now, full market move. Also, we look at some of the fallout if there was to be a default in Russia. PIMCO having about $1 billion of CDS exposure to Russia. This is Bloomberg.
This war is just exacerbating trends that we were already seeing.
We need to see how long this conflict plays out and how disruptive the sanctions regime actually is.
The challenge, of course, is what is going to be the lasting effect of the oil prices.
It seems to me that Putin, in poker terms, has gone all in. So he either wins or he loses.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, March 11th. Our top stories today: a volatile week in the markets comes to a close. U.S. stock futures and European equities fluctuate. Meanwhile, Goldman Sachs says the chance of a U.S. recession next year may be as much as 35%. Ramping up pressure, President Biden is set to call for an end to normal trade relations with Russia. That would lead to higher tariffs on Russian imports. And Wall Street is saying goodbye to Russia. JP Morgan has joined Goldman Sachs in pulling back from the country in response to the invasion of Ukraine. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. And Kailey, a calm start to the European and U.S. pre-market session, especially after that turmoil in Asia.
Yeah, it was not a pretty picture in Asia overnight, at least when it comes to the equity market, Danny. Broadly, a down day for stocks. The MSCI Asia Pacific Index was down about 1.7%. The big drag largely was technology. The Hang Seng Tech Index ending the day lower by 4.3%, already a very big decline, and that was well off the lows of the session. It was down by as much as 9% intraday. There is some concern about potential delisting of Chinese companies here in the U.S. after an SEC filing said that several of those companies may get kicked off of U.S. exchanges if they don't comply with certain auditing rules. So that taking that index to its lowest since March of 2020. In other asset classes, I wanted to point to Chinese bonds. We saw the 10-year yield coming in 6 basis points. We are sub 280 on that yield after we got loan data out of China that showed credit growth slowing more than expected in the month of February. And in FX, all Asian currencies are weaker against the U.S. dollar today, but the big laggard is the Japanese yen, actually weaker for a 5th day in a row. Its longest losing streak since going back to September. It's weaker by about 0.7%, and at 116.92, that is the weakest level for the Japanese yen going back 5 full years, Matt.
Unbelievable. I mean, that could be a risk-on signal. The S&P 500 right now up about 0.5%. The Bloomberg Dollar Index also getting bid. Now, this is why maybe the weakness of the yen isn't that telling, because investors have really been using the dollar as a haven. The U.S. 10-year yield rising as investors let go of some of that debt. Not a huge move, but we're just about 199 here, 198.99. And crude, it's up almost 2% today, but only to, and I say only, 107.87, because just 2 sessions ago, Danny, we were trading over $125 a barrel. So the volatility here has been obviously something to watch.
Yeah, we've seen points where crude has swung $20 in one day. That by far is the most ever. But yeah, things are a little bit calmer so far today to start the morning. Maybe it's a day to stop and reflect, especially after the ECB and U.S. inflation yesterday. In Europe, we're largely higher by more than 1% when it comes to the DAX and the UK. But another facet of this might just be that there's been so much selling over the past few weeks. Bank of America says that up through Wednesday in that week, $13.5 billion is the amount of dollars that's fled European equities. That is easily the most on record. So selling done at least for today. Now, in some individual stocks, selling is still continuing. ING Group being one of them, the Dutch bank. Now that Goldman and JP Morgan are looking at leaving Russia, which we're going to get in with our Sonali Basak in just a bit, Bloomberg Intelligence says that Europe is likely next. What does that mean for banks like ING who have high exposure to the region? We're also continuing the story of assessing an ECB that surprised markets. Yesterday, it was enough to send BTP yields to just 7 basis points from that high reached when the ECB had their initial hawkish pivot back in February. But we are drifting ever so slowly down today, down about 1.7 basis points, but still near that very rich level. Brent crude, much like WTI, as you were pointing out, Matt, up $2% rather, but still off of the highs. And finally, nat gas just flipping to gains. It had been down as much as 8%. This is Dutch front month futures, but now it's up 2%. The optimism had been that Russia left out energy markets from their ban of imports, but again, we're starting to see that flip. Markets getting anxious about the energy story, Kailey, and what that means for inflation.
Yeah, I think they've been anxious about the energy story for some time, Danny. Now let's take a look at what is ahead today. China's National People's Congress has concluded its annual gathering in Beijing. Meanwhile, if you can believe it, it is the second anniversary of the World Health Organization declaring the coronavirus outbreak a pandemic. Yes, with everything going on in the world, we are still in a pandemic. And of course, EU leaders are wrapping up their meeting in Versailles, France today. They will discuss how to strengthen European sovereignty, reduce dependencies, and design a new growth and investment model, Matt.
All right, very interesting stuff to watch then on this Friday. And we watched last night the U.S. Senate passing a $1.5 trillion spending bill that includes $13.6 billion in security and humanitarian aid for Ukraine. The bill now goes to President Biden's desk for his signature. And Biden spoke on Ukraine support yesterday.
The United States and the people around the world are going to continue to support the Ukrainian people, I believe, as they defend their country. Ukraine will never be a victory for Putin.
Let's get the latest with our team coverage from around the world. Our reporters in D.C., France, Poland, and New York. We'll start with Washington correspondent Anne-Marie Hordern. Anne-Marie, Bloomberg has learned President Biden is set to call for an end to Russia's preferred trade status today. How important is this?
Well, it basically revokes the normal trade status you have of countries that are part of the WTO. And Matt, this is just part of the United States, also the G7 in Europe. Washington is working alongside with to approach this in a multilateral way. And it basically means that any imports that come into the United States, there will be higher tariffs for. So this puts Russia now in a camp of the likes of North Korea or, say, Cuba. We should note that the president cannot unilaterally do this alone, but already there is a lot of talk on Capitol Hill from Democrats and Republicans that they, in fact, wanted to make this move anyway. So the president will be announcing this in the 10 o'clock hour. It's just more penalties to come from Russia as that invasion continues.
All right, Anne-Marie, thank you very much. That's Bloomberg's Anne-Marie Hordern in Washington. Now to Bloomberg's Maria Tadeo joining us with the latest from Versailles in France, where the EU summit is taking place. And Maria, President Zelensky had said that he wanted EU membership to come out of this summit. Is there progress being made towards that?
Well, Danny, remember, President Zelensky said he wanted to be fast-tracked into the European Union. The Ukraine aspires, and by the way, this is in their constitution, to join the European Union. What the Ukrainians argue is that we've been fighting like hell for 2 weeks. This is a monumental effort that the country has made, so therefore we deserve to be fast-tracked into the Union. Now, yesterday, European leaders were here until 2:30 in the morning. They did agree on language that says Ukraine belongs to the European family, but there is no explicit mention to this fast-track application. Of course, some leaders argue that at this point it's unrealistic. The country is literally at war. Now, the other thing that I would point to, Danny, here there is an active debate on sanctions. There's also about weapons. But really, the fundamental question for leaders today is there even a diplomatic solution to this? And I should note that pretty much every Eastern European leader that I've spoken with in the past 2 days tells me they're growing pessimistic, that there is no diplomatic way in sight. The issue right now is that Vladimir Putin faces a war that he cannot win on the ground. There's huge resistance from the Ukrainian people. If he can't have it, he's going to destroy it. That is their take on this. So again, it makes the negotiations going forward very, very tricky between the two sides.
All right, Bloomberg's Maria Tadeo in Versailles. Thank you for your great reporting throughout the week. Now let's get to the latest from the Poland-Ukraine border. Bloomberg's Tom McKenzie is on the ground there. Tom, we understand that overnight 2 cities in western Ukraine were hit by airstrikes that hadn't previously been targeted. How could that exacerbate the flow of refugees over the western border where you are?
Well, Kailey, we've heard that 40,000 civilians in Ukraine have managed to use those humanitarian corridors to evacuate cities from those bombardments. We know as well, though, that, as you say, in the south of the country, particularly around Mariupol, that port city continues to face bombardment and is, by all accounts, facing a humanitarian crisis. And as a result, the refugee flows continue. The top-line numbers for the United Nations, now 2.3 million refugees have fled Ukraine across into countries like Poland, Hungary, Slovakia. But it is Poland, here where I'm standing on the border with Ukraine, that's taking the bulk of those. 1.5 million refugees now into Poland, a population of 38 million. And we continue to see them. The lines behind me, hundreds of people crossing, again, mostly women and children. And then the importance of this, linking this, the direct linkages between the suffering here in Ukraine to the policy making in Brussels and in Washington. The human stories here, the proximity of this battle, and the fact there's no guarantee that at some point it won't cross this border. And that seems to be underpinning the kind of decision making we've been hearing about from Maria and Anne-Marie, of course. A personal story, I was speaking to one mother, Anna, with 2 children, a 6-year-old coming from Kyiv. Half the population there has now fled according to officials. She says she wants to see a no-fly zone instilled in Ukraine. She wants to return with her 6-year-old when the country is safe so that he can see his father again and go back to school and have pizza with his dad, who's now probably going to have to take up arms to fight the Russians.
All right, Tom, a lot of dramatic and really tragic stories there coming from the border. We hope that everyone gets support that they need. Goldman Sachs and JP Morgan are joining the corporate exodus from Russia now in response to the invasion of Ukraine. Let's get to Sonali Basak, our Wall Street correspondent, for more. So, Sonali, how difficult is it? We've been talking about this for a couple days now, to unwind from Russia.
On one hand, a lot of these banks have fairly limited staffs there, retreating quite a bit from 2014. But on the other hand, they are still making markets in these businesses. So Goldman Sachs, which has the most aggressive language, saying they will do a full withdrawal with about 80 staff there, they are still making markets. They were clear, however, to say they're helping clients reduce risk and not seeking to speculate. We also had news overnight that Morgan Stanley is considering moving some of its 20-strong based Russia staff to the Gulf state and other financial centers. Remember, these were 3 banks, Goldman, Morgan Stanley, JP Morgan, that in 1998, there were stories about bankers tripping over themselves to help with the sovereign debt crisis at that time. It's been a decades-long entrance into Russia and now a very blunt retreat.
Sonali, what else are your sources watching as this unfolds, as more banks join this choir saying that they're going to leave Russia?
Yeah, it's interesting, Danny, because on one hand, you have some of the transactions that they have to unwind with counterparties such as VTB, where not only is the unwinding difficult when it comes to sanctioned entities, but also difficult when it comes to figuring out what the price of the underlying securities are. So unwinding trades is of critical and most immediate notice. But then if you look on Wall Street on the client side, they're not looking at just Russian debt and seeing what's happening. They're looking at the entirety of emerging markets as well and seeing what opportunities there are on things that might have sold off on the sidelines. There are some that are still debating whether they want to buy Russian debt or CDS. The other thing that is really important to watch here, I think, is how at the whim of geopolitics a lot of these banks feel. They're not only closely watching Russia, but they're also closely watching China and Saudi Arabia to see how the Biden administration's relationship starts to evolve over time as they maneuver a lot of these geopolitical tensions.
Yeah, a tricky global landscape to navigate. Thank you so much to Bloomberg's Sonali Basak. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I'm sorry, Danny, I know you hate it when I talk about 3 down movers, but we have 3 massive declines for 3 individual stocks today. One is Rivian, of course, the electric pickup maker. Its revenue missed expectations. It had a wider loss than expected, and it's not going to be able to produce as many vehicles because of supply chain issues. As a result, that stock is down 11.5% after earnings. It's another big downside mover after earnings for DocuSign. This is the electronic signature company. Its revenue guidance missed expectations. That stock down 19% as a result. And the final double-digit downside mover, DD Global. This is the Chinese ride-hailing giant. It was expected to delist in the U.S., relist in Hong Kong. Bloomberg reporting overnight it has now halted that Hong Kong listing that was expected due to issues around that cybersecurity probe. Apparently, it hasn't been able to meet what regulators were desiring. As a result, that stock down about 15% before the bell, Danny.
I will flag to our viewers that S&P 500 futures are up 0.5% in case you too feel bummed by 3 consecutive down movers. Kailey, thanks. Well, coming up on the markets, we're going to continue the conversation with Karim Chedid, BlackRock investment strategist, as we look at the turmoil and the wild ride of this week, plus more on the war in Ukraine with Olga Onuch, senior lecturer in politics at University of Manchester. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz. Danny Berger is with us out of London. Now, we had a monster inflation number, a monster CPI number out yesterday, 7.9%, a fresh 40-year high. But that hit before the spike in oil prices, or it didn't include that. I have a great breakdown here. Those of you watching on TV can see this. Those of you on radio, I'll walk you through. What we're looking at is headline number of 7.9%. That comes 2.5% from services, 2.5% from goods, but only 1% in change from food and 1.6% from energy. That's going to change drastically. So inflation is likely going to be much higher the next time we look at a reading. Bloomberg's Eddie Vanderwalt joins us now from the MLive team to talk about, what this means, Eddie, because we have everyone downgrading growth forecasts, Goldman Sachs chief among them, but also the ECB, and inflation that looks like it hasn't topped out yet.
Dare we say it, Matt? Stagflation's on everybody's lips at the moment, right? I think that, and you've hit all of the right points here. The problem for the Fed and for other central bankers is that they can't control an oil spike, right? They can't control high energy prices. This is something that is generally seen as outside of their remit, and they usually try and look through these things. But those things feed through. They feed through into food prices and other things. And we're now seeing wheat and all of those, really hard commodities pushing higher. And that's going to keep adding to this pressure that we've seen over the last couple of years. It's a really difficult problem for the central bankers to solve at the moment.
Well, as we try to wade through these central bank decisions, Eddie, I'm kind of scratching my head on what the euro did, because you get this initial spike up after the ECB decision that's more hawkish than expected, and then just kind of drifts downward. What do you make of that?
So I think there's two factors at play for the euro at the moment. Of course, the ECB came back a little bit more hawkish than people were expected. So, that initial reaction is fair enough. But then if you listen to the ECB is quite bearish about the Eurozone and saying, yes, growth is strong now, but they're also talking about how Ukraine was a watershed for the Eurozone. And I think that's a problem because, that spills over into a haven demand. And the dollar is the ultimate haven at the moment. And I think that's what accounted for the turnaround.
All right, so you're talking about actual fiat currencies. Eddie, can I just get your thoughts on cryptocurrencies? Bitcoin right now hanging around $39,000, essentially exactly where it was last Friday. What do you make of the action that we're seeing in Bitcoin?
It's a really interesting environment for Bitcoin because, of course, a lot of Bitcoin investors have been talking about exactly this sort of environment where the US dollar becomes, unfriendly towards Russia and other central banks. And that, talking about whether those central banks might want to diversify into cryptocurrency. We haven't seen any move along those lines. And I think that accounts for some of the negativity that we've seen in Bitcoin. But also, Bitcoin still, it's not a haven at the moment. It is acting as a geared play on high beta tech stocks. And I think that's how it should be treated. And while tech is under pressure, Bitcoin will remain under pressure.
All right, we'll leave it there. But thank you so much for joining us, Eddie Vanderwalt of Bloomberg MLive. And speaking of crypto, don't miss Bloomberg's new weekly show, Bloomberg Crypto, hosted by Matt and me. The first show will be debuting on Tuesday, 1 p.m. New York time, with billionaire crypto investor Mike Novogratz. Don't miss it. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Now let's keep you up to date with news from around the world. Here's the first word. A new study says that the global death toll from the coronavirus could be 18.2 million. That's 3 times higher than official records suggest. The study from the University of Washington points to a lack of testing and unreliable data to explain the discrepancy. President Biden presented an optimistic vision of the Democratic Party's chances in November's midterm elections. The president told the Democratic National Committee that the party's economic message resonates. But Democrats will have to fight off Republican claims that those policies have led to the inflation that's cutting into Americans' purchasing power. The International Monetary Fund no longer sees a Russia debt default as an improbable event. IMF Managing Director Kristalina Georgieva says that it's not that Russia doesn't have the money, it's that Russia can't use its money. Unprecedented sanctions will make it difficult for Moscow to convert its IMF reserve assets into currency. And Major League Baseball and its players' union have said, play ball. The two sides reached a tentative labor agreement that ends a 3-month lockout and paves the way for the start of the season next month. The deal averts a potential disaster for a sport that was already coping with the loss of TV viewers. So good news, Danny, there's no more crying in baseball.
There's always crying aloud in baseball, Kailey. Well, as we look at a market that's made many people cry with the volatility reaching levels not seen since the COVID sell-off, we're going to dig into it with Karim Chedid, BlackRock investment strategist. This is Bloomberg. This is Bloomberg Surveillance, the early edition. Here's what you need to know. A volatile week in the markets is coming to a close. Investors have been going back and forth between panic selling and dip buying. They're bracing for a likely interest rate hike by the Fed next week. At the same time, Goldman Sachs says the chance of a U.S. recession may be as much as 35%. President Biden is set to ramp up the pressure on Russia. Bloomberg has learned the president will call for an end to normal trade relations with Moscow. That would clear the way for higher tariffs on Russian imports. It's up to Congress to make the final decision on the matter. And JP Morgan and Goldman Sachs are leading Wall Street's retreat from Russia. JP Morgan says it's currently engaging on limited activity there only. Goldman has said it plans to close Russian-based operations. I'm Danny Berger in London, in for Anna Edwards with Matt Miller and Kailey Leinz in New York. And Matt, today just feels very, very calm compared to the rest of the week we've had.
Yeah, calmer than you are, dude. We're looking at futures that are up about 0.5%, but yeah, not a lot going on in terms of, we have a little bit of a bid for the Bloomberg US dollar index right now at 1,200, unchanged completely on the 10-year yield, so 198.64. They're relatively high level still, but just not a lot going on. 4 hours away from the open, I should point out, so a lot can happen. Crude is up, but only 282 at 108.84, and on Wednesday we're up above $125 a barrel. So we've seen some massive swings compared to this. It just is relatively chill right now. Kailey, what are you seeing in terms of pre-market movers?
Danny, he called me Kailey. I guess I'm not dude. You are dude. In terms of pre-market movers,
I am the dude.
What's moving to the upside? You are getting a lift for some of those travel stocks once again. The likes of United Airlines, Carnival Cruise Lines, they're each higher by around 1.5% to 2%. But some big movers to the downside. Some of them earnings related, some of them not. On the earnings side, Rivian reported after the bell yesterday. Revenue missed expectations, wider loss than expected, and its production not going to be where the company was hoping it would be this year due to supply chain challenges. So that stock is down about 11%. And down 14% is DiDi Global. That's the Chinese ride-hailing giant, halting its plans to list in Hong Kong due to that cybersecurity probe ongoing with regulators. So that stock sinking 14% before the bell, Danny.
Kailey, I'm just trying to find my inner zen right now after Matt told me I have no chill. So I'm going to be very chill for this market check. We are seeing European stocks move higher as we go through the session, up more than 1%. It's interesting to look at some of the single names gaining, Wizz Air being one of them. Wizz Air has lost about a quarter of its value since the war broke out. There's this concern over higher oil prices, but HSBC out with a note upgrading Wizz Air, not saying because the fundamental story has gotten better, but essentially saying it's sold off so much that you can kind of just hold it now. You don't have to keep pressing that sell button. BTPs have been fascinating. Yesterday, we had this big spike up in yields following an ECB decision that was much more hawkish than many expected. We're coming back a little bit, about 2.5 basis points, but we're still around 9 basis points from the high that was set in February. And finally, natural gas flipping from this morning's session. It was down as much as 8%, up yet again for 6.9%, but of course around 7% is kind of nothing, Kailey, compared to some of the double-digit moves we've seen on natural gas in Europe.
Yeah, volatility has definitely been the name of the game, Danny. So let's talk more about these markets. Joining us now is Karim Chedid, investment strategist at BlackRock. Karim, I actually want to begin with the call we got from Goldman Sachs overnight that the U.S. economy could be heading for a recession next year, that probability as much as 35%. How do you view the potential growth hit from the crisis in Ukraine and the resulting sanctions, the resulting impact on energy prices? Is that something you can even really model at this point?
Thanks. Yeah, I think there's two aspects to that impact. The first is inflation. We are seeing an inflation shock, which is very much supply driven, very much centered around the energy prices that have been increasing that we've been seeing. And the second is, at which point does that shock start to hurt the growth picture, the demand picture, the consumer demand picture especially? So on that first one, the inflation shock, I think we are seeing an extended shock to inflation prices that is likely to keep that peak of inflation higher and a bit more delayed than initially, following on the supply shock that we had earlier. And then on the growth shock, we are starting to see some hurt, but we have to bear in mind that consumers were actually in a very good place before this and have a lot of household balance sheets have a lot of cash.
But if it's supply shock we're coping with, and we've already had this before, and it's accelerated, is this the kind of inflation shock that the Fed and other central banks are equipped to deal with?
Well, that's a great question. I think looking at it as an extended supply shock means that we don't really see central banks reacting as aggressively as they would have to a more demand-driven shock. But they are in a tight place because, on the one hand, they don't want to react too aggressively to inflation, especially if growth starts to weaken. And we're already past the peak growth as of the start of this year. We're already moderating from the highs. But on the other hand, so on the one hand, they don't want to react too aggressively, but on the other hand, they do have to nod to that inflationary picture.
Well, there was a point where this is all markets traded on, right? How aggressive the Fed was going to get. But does the market care anymore, or is this just a market that will only trade on headlines related to war?
I think the market has become more sensitive to inflation releases. So we had the CPI yesterday in the US, which was in line with expectations. But it's also become more sensitive to data more generally and to the commodity prices. So that's why we're starting to see an environment where we're actually seeing commodities and risk assets becoming more negatively correlated. So oil goes higher, equities go lower, as we saw a couple of days this week. That type of pattern, I think, might be with us to stay for a bit longer.
I wonder if you think that the mood music is more negative than the numbers we're getting out of official forecasts. I mean, Goldman Sachs, to go back to what Kailey kicked it off with, Goldman Sachs saying only a 35% chance of a recession next year. That seems low to me, Karim.
I think we need to distinguish here between the global and the US economy and the European one. If we zoom in on Europe, there is a bit more vulnerability to both energy as well as the imports of energy. And so the European economy may be a little bit more at risk, although if we look at the ECB's latest forecasts at their meeting yesterday, yes, we saw a hit to growth for 2022 and an increase to inflation. But if you look out to the midterm, the ECB is seeing those fizzle out and is seeing inflation specifically remaining just below that 2% target, which is good news if it were to be true for markets. For the US, I think there's a bit more resilience there in that the economy is less dependent on energy, less vulnerable to those energy shocks. And in the case of the US, we have a really strong growth picture coming from that economic restart that is underway. And ultimately, we're seeing investors nod to that because we're starting to see a pickup in preference in ETF flows towards US equities, towards quality equities as a reflection of that.
Would peace be a surprise, Karim? I mean, if we got some way for Russia to back out and try and put things back to normal, would that surprise markets?
I would point to gold. Gold is very much a safe haven trade. And if you look at the way that gold has been performing, there is an extensive risk premium attached to the gold price with regards to political risk. So to answer your question, I think there's a lot in the price already from a political risk perspective for markets, and gold is a reflection of that. It's trading above fair value, so there's room for that to unwind if we have any any positive surprise, to use your words, on the political front.
All right, Karim Chedid of BlackRock, thank you so much for joining us today. Just want to get to some breaking news quickly as it regards the Iran nuclear deal. The EU's Borrell now saying that those Iran nuclear talks need a pause, saying that that is due to external factors. Something tells me the war in Ukraine and the sanctions on Russia have a little something to do with that. We are seeing WTI futures at session highs on the back of those headlines. Right now up a little more than 3%, trading at 109 a barrel. But remember, we closed Monday at 119, so we are still well off those highs of the week. Now, coming up, we will talk more about geopolitics and the war in Ukraine. Olga Onuch, senior lecturer in politics at the University of Manchester, will be joining us next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, Mark Mobius, Mobius Capital Partners founder. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
It is a war crime. It's very clear, and Russia is denying it. But we have seen such horrible pictures also in the recent history. Vukovar, remember Sarajevo, and the same denying and the same propaganda going on. But I think that we shouldn't tolerate this. We have to do much more than we are doing now.
That was the Prime Minister of Slovenia there speaking to Bloomberg earlier today. Well, let's get more on the war in Ukraine with Olga Onuch, senior lecturer at the University of Manchester. Olga, thanks for joining us this morning. And a lot of the work you do focuses on the people of Ukraine, attitudes there, surveys. Over the past 14 days, how has the Ukrainian feeling, the attitude towards the war changed?
Well, it's everything that I think Western analysts did not predict, and certainly Putin did not predict. The resolve and resolute nature of Ukrainian civic identity and attachment to homeland and state is only growing stronger. So I have some fresh data from March 9th that came out on March 10th. And we see that 91% have hope and faith that Ukraine will prevail in this conflict. Of those that were surveyed, 97% tell us that they will remain in country. 39% are already volunteering towards the war effort, and about 37% are donating whatever funds they have at home. So we're seeing the continuity of just everyone binding together and contributing to the war effort in Ukraine. Again, not what we perhaps, or some of us in the West might have expected.
And Ukraine, we heard yesterday from the foreign minister that Russia essentially said the attack will continue. They want Ukraine to surrender. Ukraine says that it will not. If there is a fundamental disagreement about what would bring peace, territorial disputes, when Ukraine says it's not willing to cede an inch of territory, is it possible for a diplomatic solution to be reached?
I think it is possible for a diplomatic solution to be reached. I think Zelensky's government has really demonstrated the capacity to engage in good faith in negotiations, something that many people also did not think would happen. And I think they do have in their own group, they have an understanding of where negotiations might be going, where they would be willing to compromise on. These are obviously things that are not going to be made public in any way. But I do think if the Russians come to the table asking the exact same thing, when they are in fact tactically losing a series of conflicts around the Ukrainian territory, where they are losing the hearts and minds of any Ukrainians in the east of Ukraine, any Russian speakers in Ukraine, and quite frankly, fresh data out of Russia shows some decline in support for the war effort on the Russian side. We're seeing some Russians reporting interesting things there.
Okay, so if you have declining approval at home, you have declining approval in Ukraine, the military is not performing, sanctions are being rained down upon Russia, what position does that put Vladimir Putin in? Is he going to have anything else to lose, and does that make him inherently more dangerous?
I think Vladimir Putin has shown us that he is dangerous. I think any Western allies or partners that thought that Putin specifically, if not Russia, were someone that you can work with, that was reliable. They have been shown very demonstrably that that is not the case. But I think should the conflict go as it is, should the war and invasion go in this very slow step, I think Russia will likely try to escalate, will likely or potentially use other types of weapons, including different types of tactical weapons, as well as potentially chemical warfare. This would be horrific. This would be tragic. The consequences of this would follow Putin and his Kremlin insiders and their extended families that are now in safety abroad for years to come. This would not go unpunished.
So, the concern that Kailey, had and that I had this morning is just that it seems like we've gotten to a point where Russia's invasion of Ukraine is irreversible. There's no way to pull out. There's no exit. And especially as, President Biden has come out and the U.S. has come out as extremely aggressive. Not that that's not warranted, but, it seems more dangerous this way. Is that the wrong take?
Again, I don't think it's more dangerous. I think it's as dangerous as it always was. Perhaps some people were miscalculating the level of threat and danger. But I do think there are so-called off-ramps for Putin, even as it is today. Putin can just announce to his population that Ukraine has been demilitarized, right? If everything is built on internal propaganda that is false, misleading, fake news in many ways, he can just as easily ramp up the propaganda machine to declare victory and show a variety of evidence to that effect. So I don't think that if Putin wanted to, he can't spin this as a win for himself.
Is it possible that the oligarchs put any pressure on him, Olga, as we see, Chelsea Football Club being taken away from Abramovich?
It's not clear how much actual pressure oligarchs can put on Putin himself, but they might be able to put pressure on other Kremlin insiders that might either nudge Putin in a different direction or themselves, in fact, try to take power. So I think when it comes to oligarchs, they are very much still reliant on the state, reliant on being in Putin's good favor, but they do have other abilities to put pressure on other individuals that we've heard some of these rumors coming out in the last week, and that is very much possible.
Olga, thank you so much for joining us this morning. Really fascinating stuff. Olga Onuch, senior lecturer at the University of Manchester. Well, coming up in the next hours, the conversation on Ukraine and Russia continues. Gallup editor-in-chief Mohammed Yunus joins the program. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Very much in today, though, Tom Keene, co-anchor of Bloomberg Surveillance, who joins us now. Tom, it's been one of those weeks that's felt like a month. So much has happened from CPI to the ECB, volatility in commodities. What are you looking at today?
There's any number of stories today. We're going to cover them across 3 hours this morning, and then I believe there's a bonus hour later, and then a bonus hour with John Farrow this afternoon. And with all that is a global Wall Street uproar. And this is over the closing of the London Metals Exchange. I'm not going to go into all the details now, but the chart speaks volumes. Nickel, normal. Nickel not up to $100,000, the circle up top, coming down to normality, and then it flatlines. And it flatlines because the LME, as they did in 1985 in the so-called tin crisis, shut down the exchange. There are three parties. There are the physical goods people, which is who LME is defending. There are those long and there are those short, depending on the trade. In this trade, short was benefited and longs got absolutely crushed, those betting on nickel higher.
I've also noticed that the perception is a lot worse than the data, Tom. Yesterday we had a story, and I know you have Mohammed Yunus on from Gallup, which is why I bring this up. Yesterday we had a story that low-wage earners think that their salary isn't keeping up with inflation, but the data shows that it is, at least over the last 2 years since the pandemic started. I also thought when I saw Goldman's forecast today, only 35% chance of a recession next year, I thought, man, that seems low.
I don't agree. I think that the Goldman shift is a shift that we're going to see many, many times over the weekend. I actively await Michael Feroli's publication this evening of what J.P. Morgan believes, and of course Ellen Zentner, Morgan Stanley, and the rest. And I'd suggest, Matt, this is the beginning of the markdown on growth. And as I've emphasized the last number of days, within all the market dynamics, it all falls back to growth. And I would suggest the growth dynamic in Europe is more critical even than in America.
Well, in America, Tom, I do wonder how higher oil will play into the consumer story if that starts to shift even more severely as it filters through.
That's why we have such negative perception.
Well,
yeah.
I would suggest that we've got stasis here at 111, which is somewhat within the range of where we were 6, 7, 8 years ago. And that's down from the panic of a number of days ago. But this story's long from over. And the effect of it is tangible to a huge body of Americans.
Certainly is. Tom, thanks so much. It's Tom Keene, co-anchor of Bloomberg Surveillance, who will be back on the program in just a few minutes. And Kailey, look, this is part of it, is that these markets have been so volatile and they're more calm today, but it seems that volumes are off. I don't know how much we can really trust the calm and that it will stick around.
Yeah, maybe volumes are down because everyone's just exhausted from trading this week because it's been wild, and it's really across asset classes. You're seeing it in the bond market, you're seeing it in the equity market, even more so in commodities. Tom was just speaking to that. I mean, I'm taking a look at oil, even just shy of 110, actually just breaking through 110 on WTI on the back of some of those Iran nuclear deal headlines, maybe putting a pause on that, which would put a pause in theory on supply coming back onto the market. Even at 110, Matt, that is still well off the highs of the week. WTI on Monday was at 119.
True, but that's no longer calm. I think when we're seeing now 3-4% moves in oil, and I guess we're at session highs right now. So I would say this is something to watch as we get closer and closer to the start of trading on Wall Street, just 3.5 hours to go. Otherwise, I think, it's really the gas prices, Danny, you pointed this out, that make perception so bad. And I wonder if that negative perception, moves us into the recession. I think 35%, I felt like we must have a 50% chance of a recession next year.
Yeah, well, this is something Danny Blanchflower talks about all the time, right? How important consumer sentiment is. But just in terms of sentiment, Kailey, the flow show from Bank of America, I was dumbstruck. 13.5 billion pulled from European equities. That was double last week. Last week was a record, so this record is just no one wants to be in European equities right now.
Yeah, absolutely brutal when you look at that flows data. On the subject of sentiment, I would point out at 10 a.m. Eastern time, we're going to get University of Michigan consumer sentiment data. That will be a very, very interesting read, especially the inflation expectations within that. So shameless plug, I'll be breaking that down with Guy Johnson at 10 a.m. Eastern, Danny.
Well, I, for one, will tune back in for that. Those inflation expectations are always fascinating. We'll have a lot more interesting conversations ahead. Bloomberg Surveillance continues. We're going to hear from Bruce Kassman, J.P. Morgan chief economist, and Amy Wu Silverman of RBC Capital Markets, among others. This is Bloomberg.